It's been so fun visiting with several of you about your products and brands, and I look forward to visiting with more of you throughout the day. We're going to kind of dig in on a couple topics that are passion points, so especially for myself and our firm, and we're about to get started, but who's ready to grow? Ready to grow? All right. Who's got a plan to do it? All right, we're going to talk a little bit about that and who might need capital to actually execute. Okay. So you all found yourself in the right room. This is good. We're going to cover a lot of these topics. So let's dive in. We're going to talk about intentional growth, which is actually the title to my next and upcoming book. My first book, Completing the Deal. By the way, there's copies for everybody. Please grab them. I want to make sure that gets in the hands of every business owner possible because it was written for you. Intentional growth is really focused on what it takes to grow a business predictably. And that comes from a background of personally having closed over $5.7 billion of debt securities and M&A transactions, totaling about 175 different transactions, and having actually been an operator of businesses up to 15 million of EBITDA. I jokingly say when I was running, this was a division of a publicly traded company. This is back when $15 million of EBITDA was real money. This is 2013 dollars, so with inflation, probably closer to 30 million of EBITDA. I'm fortunate to be the CEO of an award-winning investment bank. So somebody had a question, who do you go to help find money and arrange capital for you? I'll just raise my hand for that one. That is what we do every day. We're number one ranked in Texas and typically in the top 10% of total transaction volume for lower middle market companies throughout the US. So that's going to be companies that are doing probably sub 30 million of profitability or EBITDA, okay? Earnings before interest, taxes, depreciation, and amortization. Again, I mentioned this is a little bit of a passion topic. So Completing the Deal, my first book, was an Amazon bestseller. Again, available in the back. Intentional Growth will be out in October. I've been very pleased with some of the outpouring for commentary. It's been very well received by the business community, and I speak internationally on these topics. Over my career, I've been fortunate to have worked with a number of food and beverage businesses. And what I'll say is there's a lot of transaction tombstones up here on the screen that range from produce, food, bev, co-manufacturing, brands. But it's really what lies behind the stories that's important and where we're really going to focus on today, because in order to execute well, there's a lot that goes into it. Sometimes people see the finished product or the finished press release and say, oh, I surprised so-and-so raised capital or transacted. But usually there's months, if not years, behind that process that goes into transacting well, which is where we're going to spend most of the time today. So I've been CEO of Westlake for a number of years and with Westlake for 12 years. But prior to that, I spent 15 years working for companies that had very ambitious growth plans. One company went from 2 million in revenue to 125 million of revenue. The next one went from 14 million to 350 million of revenue. It went public on the NASDAQ and then ultimately the New York Stock Exchange. And the last company that brought me from Chicago, where I'm originally from, to Central Texas, went from 10 million to 2 billion in revenue, went public on the New York Stock Exchange. And those were very unique circumstances. And I would say over the first 15 years of my career, I probably didn't appreciate them as much as I do now. But one of the key takeaways that I took from that is big plans are possible with big planning. And that's really one of the things that I think separates organizations that actually achieve what they set out to do versus those that get stuck in a little bit of a status quo or maybe fall behind. And so today we're going to talk quite a bit about that. But before we do, I want to talk a little bit about maybe the motivations for wanting to achieve outsized growth. And that is something probably near and dear to several of our hearts: shareholder value. So I'm not going to bore you with a lot of statistics today, but I'm going to share kind of two core things. One is that we are actually paid to grow, meaning companies, the larger they scale, the more their multiple is that they trade at. And so as a company grows, it's actually benefiting in two ways. Number one is the profitability, but number two is the multiple that it's going to trade at. I'm also going to share with you that if you look back over the last 20 years, we are experiencing a bit of a renaissance, in particular for manufacturing, co-manufacturing, in the sense that those businesses are valued higher than they have been over the last 20 years, the recent 2-year period in particular. And so it's a good time to want to take the risk of growth. It's a good time to want to take the risk of investment, because as you scale, your EBITDA multiple can go up, or the multiple your company is worth will go up. But then also we are looking at all-time highs. And I think that's going to continue for some time period. We hear all this about AI, so forth. And so what you see in the investment community is a shift away from some maybe companies that were in vogue 4 or 5 years ago to companies that do real things like make food, make beverages, they make milk products. Those are perceived as being products that are going to be needed for a long period of time and not likely to be highly disrupted by AI compared to other industries, in particular things like professional services. The other thing to share with you why it's such a good time is the amount of dry powder out there for investment in private companies is at an all-time high, about $1 trillion, okay? And then the core part of this that's pretty important is if you look at 21 through 23, this little statistic here is dry powder based on fundraising vintage. So every year there's capital raised. And what happens is when that capital is raised, the folks that raise it usually have a use it or lose it period of 4 to 5 years. And so if you look at this chart, about a third of all the dry powder that's available is going to enter that use it or lose it phase if you're a professional investor over the next year, 2 years. And so those people are going to have to look at places to deploy capital. And we're big believers that food and bev has been a great area the last couple of years, and that trend is going to continue for the next 2 years. So again, there's a lot of dry powder that's available for growth. And then lastly, and I'll send this around for Jim, those that want the presentation, in particular this part, in completing the deal, I talk a lot about this, is the capital matrix. Sometimes people are convinced that there's only 2 forms of capital that they can go for. One is on the far right, that's called a ABL or asset-based loan. That's typically going to look like a personally guaranteed loan from a bank. And the other one on the far left is essentially selling your company. And a lot of times people get stuck in the fact that they can either get a personally guaranteed loan or they can sell their company to grow. But the truth is there's a lot of capital tools in between that you can use to grow your business without sacrificing leadership or disrupting your culture. There's a lot of other forms of capital that you can use to expand a plant, take on a new customer, grow production. So let's dive into 5 core things I wanted to share about growth. Number 1 is reverse engineering the outcome. We spend a lot of time on this with our client companies that want to grow. And there's 2 core things that we really focus on. One is timeline or time frame. Generally speaking, we're going to recommend 3 to 7 years that we kind of view where do we want to be in 3 to 7 years. Why? 3 years is pretty short, or 2 years pretty short. Anything less than that, it's hard to see measurable outcomes in something that's like 18 months down the road. And anything beyond 7 years is, well, that's just kind of a long time. So that 3 to 7 years is a really important timeline to focus on. You can always reset, but it's a good strategic planning timeline that gives yourself enough time to execute, but not so much time that you can become complacent thinking that you have 5 more years to go, so to speak. The other thing is the destination should be worth the pursuit. If we're going to actually take the risk, if we're going to go for it, maybe we do need to sign that personally guaranteed loan to get started. We do need to raise some money from friends and family. We're going to be having those conversations about plant expansion, growing our team. We want to make sure that whatever we're planning for from a time perspective, the financial result that we're shooting for is worth it. And so that a lot of times we're talking about how can we 3, 5, 6, 7, 10x a business over a 3 to 7 year time frame. And that combination can be powerful because 1, we've got a time frame that's measurable, and 2, we have a financial destination that's exciting for both ourselves and our organizations. Number 2, we spend a lot of time talking about where are the gaps that we need to close. So if we are going to go from $1 million to $5 million, $5 million to $10 million, $10 million to $50 million, $50 million to $100 million, what are the levers inside of the organization that we need to pull on in order to achieve that? And that could be M&A, it could be changing customer terms early on in an early life cycle. It could be expanding into the next facility. It could be outsourcing certain components. For those of you that are maybe earlier stage where you're wearing a lot of different hats, there is a time to go to fractional, and then after fractional, there's a time to go to full-time. So thinking through what are the different levers that can pull for different facets of the business to help it grow. And once we've identified what are the key ones, then we want to narrow down one more time. And so what we call this is focusing on the upper right quadrant. So this is taking a look at the different levers that your business and organization has to pull in order to grow, and narrowing down to what are the things that are most important and most urgent, and then taking one step further and plotting those out. So one of the things we'll walk away with in a planning session sometimes is, there's 12 different levers that we can use to grow. Okay, we've now narrowed them down to 8, and the temptation is, well, let's run after all 8 at the same time. And we advise not to do that. What we advise to do is to take those levers and to place them over your growth map over time. And the reason for that is we tend to overestimate what we can do in 5 months and underestimate what we can do in 5 years. And so if an organization takes on 8 different initiatives all at the same time, they're inevitably going to break down, and so too will the intentional growth path. But if we've got those levers kind of placed in maybe 6-month increments and really spend focused time on executing them, the growth will definitely follow. And this is a little bit of a map. So this is kind of taking a look at some of these key levers and then saying, okay, how do these allocate out in terms of, if these are some examples of an organization in terms of the growth levers, how do we really assign accountability to outcomes? And so for earlier stage businesses, as maybe the sole leader, you're going to be wearing a lot of those hats. As businesses grow, you're going to be able to delegate those responsibilities, whether it's fractional or full-time. But ultimately, what we want to do is to pick leaders for each one of those levers. And that accountability through outcomes is something that we spend a lot of time mapping out as well. But we want to make sure that we're aligning the right task to the right person at the right time, and then giving them the tools and ability and accountability to get after it and make it happen. Then after we've kind of laid all that out, we really start to focus on the 100-day plan. And the 100-day plan is important because it starts to change the trajectory of the business. And in that 100-day plan, we really want to see 4 key things develop. Number 1 is going to be early wins. I think we're all wired that way from a human nature perspective, that if we see some levels of early progress, we are going to be more encouraged to take that next step and to continue going further. Secondly, is we want to make some of these elements very visible. So if you've got a team, employee group, we want to make some of our main goals and objectives over this 100-day plan very visible to the employee base, because what's going to happen with early wins and visibility, we're going to start to build foundations. And those foundations are going to be what we build the rest of the growth plan off of. And then lastly is kind of continuing to build a culture of accountability. And people will be more willing to be accountable if they understand through visibility what the objectives are, and they can start to see some early wins. So again, this is where we spend some of the early days from a planning perspective. So there's a few things to keep in mind when you're going to embark on an ambitious growth plan or intentional growth plan. Number 1 is to pay attention to the unique opportunity that's creating tailwinds. So Pavel and our first speaker talked quite a bit about paying attention to customer trends. Those are really important areas to watch, because if you catch the right trend at the right time, it can make all the difference. Sometimes people say, they'll kind of poo-poo timing, if you will, but from what I've seen in a lot of instances, people that seize the right opportunity at the right time tend to be the ones that find victory the most. Number 2 is, from a growth perspective, is if you look at the future value trajectory, if it's not matching up to your expectations, this can be a really good time to say, okay, tomorrow's not going to look like today. We're going to start to change something, because the entrepreneurial journey isn't super easy. And if you're not going to be satisfied with the trajectory your company's on over the next 2, 3, 5 years, it's time to change something. And you can do it. Again, big plans and big planning is all it takes. Number 3, you may have a larger organization or a medium-sized organization that had a lot of wins out of the bat, and we've started to plateau. Intentional growth and replanning for what the next 3 to 7 years can look like can be a great way to re-energize an organization. And we've seen this a lot. We've worked with a number of companies that are 40, 50 years old that have just kind of stagnated in terms of they haven't grown much faster than inflation, and they're in markets that are growing 3x inflation. And so how can we re-energize an organization that's otherwise stagnated? Something to watch out for. Number 4, planning in increments with no destination. If you've ever done a budget, this is a great example of that, in terms of we're planning for maybe a short term and budgets are necessary and needed, but a lot of times they're done without an end destination in mind. And so a lot of times when we're talking about budgets, we really want to start with where do we want to get, and then bring that budget back to today, versus simply taking a sales backlog, some operating expense, and a couple hires and putting it all into a spreadsheet and calling that a budget. That's not really the most inspirational way to do it, and it's probably not the way to keep you on a path to 3 to 5x your company over a short period of time. And then lastly, one of the things that we see is letting perfect be the enemy of good enough. If you look at the last 20 years, it's really hard to say that there's ever been this perfect time to get after planning and get after executing and deploying capital and expanding into new facilities and getting after new products. If you think back, whether it's financial crisis, health scares, wars, etc., banking crisis, various invasions, if you will, there's never really like a perfect time to get after some of these things. It's really kind of comes from within ourselves and making, again, the decision that tomorrow is going to be different than today. And so I always encourage people, some of the best companies that we saw over the last 10 years took action during some of the most difficult times. So things like COVID or things like the banking crisis, or prior to that, there was kind of little nuance upsets in certain industries that we operate in. And some of the best performing companies we've seen are people that actually double down in their efforts to grow their business during more difficult times. All right, so I want to make sure there's a couple things to share. One thing is, for everybody that's attended, we actually have an intentional growth assessment tool that I want to make available to all of you for free. It's a tool that I'm going to show you a downloadable form, but what this will come back with is a little bit of information. It'll give you a score, and it will give you about 20 ideas that you might want to implement or think about implementing in your business today. This is complimentary. Normally we go through a process where we charge for those sorts of things, but this is something that is a passion for us. I want to make sure you walk away from today with something that's highly actionable, and I think this could be a great way to do that. Also, one thing I will mention, for a select group of folks, as we see information come in, I'd like to donate some of our firm time back to a handful of organizations. I think we're going to pick 3 organizations to donate a roadmap, so that reverse engineering roadmap that we went through. Again, normally that's like $10,000 of our time. I want to donate that back to 3 companies. And so as you're filling out that form, we're going to hand select 3 companies to go forward with that will get that as part of this. And so the way to access that is going to be on the QR code on the right. And also to take a look at intentional growth is on my left. But I think, as Pavel mentioned, this is a wonderful time to be taking advantage of growth opportunities out there. There has never been a better time to have access to capital from an entrepreneurial perspective. So whether it's equipment financing, or there's equity investments, or simply looking at more simple structures, or building something to sell, that whole combination of potential growth, development, and transaction types is about as attractive as it's ever been. And so one thing, if you take anything out of this today, I would just encourage you guys, simply by being here, you're taking a step down the right path. So it's an exciting time to be in food manufacturing, and I definitely look forward to learning more about and hearing more about your all success stories as you continue to grow and shape your businesses. So with that, I'm going to take some questions if anybody has them. We typically raise anywhere from, we've raised 500,000 all the way to 500 million over the last 10 years for various transactions. So most of the companies that we're working with are going to be looking to raise low 7 figures through mid 8 figures in terms of total capital. And then from a sell side perspective, or when a company is ready to sell, maybe anywhere from 10 to 300 million of value is about where we generally play. That's a great question. I would say the diligence process, first and foremost, is fairly robust these days. And so being diligence ready is also super important as you go down a path of potentially raising capital or looking for liquidity. When it comes to the people aspect, it's usually going to be number one. You can have a product that's working, you can have a facility that's working, but if you ultimately don't have the trust and belief that the people can 2, 3, 5x a business, that's kind of where the conversation starts and ends. So much of this is based on what your core belief is in the entrepreneur and founder.
And I perhaps put out a false thesis that was false looking through innovation. Where do you think it's at? And are the big companies leaking it, or they?
So great question. We continue to see a lot of very interesting emerging brands that will come up. I think there's going to be a huge emphasis on products that are better for you. I think there's going to be a huge emphasis on personal taste profiles and niches that will continue to develop, and some of those niches will become mainstream products. I think the industry, by and large, looks to smaller organizations and earlier stage organizations for this sort of innovation, as opposed to the innovation kind of coming from the top down. So I think you all are kind of at the forefront of what's next, as opposed to what's next coming from a large publicly traded company. So the question is, what is our fee when helping to raise capital? It's never enough. So we're very transparent with that. There's actually a couple surveys that are out there that talk to what investment banking fees are for various size transactions. And whenever we're working with a company, we actually share that survey information so that there's comfort in knowing what the industry price is at relative to what a proposal from somebody like us would be. So there's kind of three main types of capital. There's senior debt. A lot of times that's going to look like a personally guaranteed loan from a bank. There's sell side or equity raising, and then there's stuff in the middle. Generally speaking, based on the size, senior debt can be 1 to 2%. Equity can be anywhere from 3 to 6%. And different types of capital in the middle would range kind of in the middle, actually. There's some great programs out there, in particular, the SBIC, USDA, there's some great programs that are offered through banks that have supplemental government activity that can be really interesting for growing companies. And so that tends to be kind of the middle capital that I mentioned. Maybe time for one more. There we go.
Yeah, did you mention, is that a show? What it was when you said it? Dry powder?
Oh, yeah. Great question. So dry powder, pretend I'm a private equity fund for a minute and I raise $1 billion and you're my investor. This is good. I'm glad you have $1 billion, by the way. We're going to be good friends after this. When I raise that capital, you basically sign a piece of paper that says you're going to provide that capital to me as I invest in her company. Okay. You don't actually give me the $1 billion. And so that dry powder represents the commitment you've made as an investor that I have not used. And so if I invested $100 million in your company, you would have given me $100 million. I'd still have $900 million of dry powder with you. Okay, so that for the rest of you, that means I have $900 million to invest amongst the rest of you. And so that dry powder of $1 trillion is a lot of money. That's unused capital that's been committed to be put to work, but hasn't yet been put to work. If I had $1 trillion, I would not be here today. So we actually subscribe to several private data sources. It's not generally publicly available information. We spend over 6 figures a year in terms of gathering private data from different transaction types. And then we aggregate that information into different slides and valuation trends that we look at. So, but it's not something that you can like easily chat GPT or just kind of publicly available on the internet. Those are usually subscription services that are they're very careful with their information and sorts of things like that. These would be formal commitments that have been made and tracked in private databases, and so that is all very real information. That's not like, well, maybe I'll invest $1 billion today, maybe I won't. There's actually been signed pieces of paper that make that data stat up. Yeah, of course. Yeah, and there's also other banking software on the commercial side that will look at NAICS codes for different kind of gross margin and profitability trends too, and that are kind of interesting as well. So if you're at a credit union, you may actually have access to something like that. So it's kind of cool. All right, thank you, Jim.